Hello everybody, hope you're having a good day. If you're like everybody else, you're probably asking yourself what has been going on in the stock market lately. We've had some crazy swings up and some crazy swings down. Yesterday the Dow Swing was 500-point swings from its top to its bottom, and it's been rather intense. When you look at it, it does make sense, even though at first glance it doesn't. On Friday we opened up really high and then we came right back down, and that's really all it was just trying to fill the gaps. And then we filled the gap on Friday, and then on Monday we came up again. The bulls came into play on the futures over the weekend, but we left this big gigantic gap underneath it, so all we did was come down and close the gap. And then on Tuesday we opened down, so we came up and closed the gap. Now it's Wednesday and we're gonna open red, so we'll likely come up and close the gap. Why is this happening? Well, it's because everybody's trying to figure out, everybody's just buying time for economic data on Friday, Fed minutes next week, triple witching, expiration coming up third Friday of the month. There's a lot of things that are about to happen, and we're really just buying time. I do want to show you a little bit of the bull case. If we look at the Russell, we could see where we had this line right here, which was the bottom. This is the bottom of the breakout, and the bottom of the breakdown. Once we broke down, we came and we retested that line over and over and over and over, and then we broke down. So here's the breakdown, and we're getting awfully close to reaching that breakdown spot. That's the weekly chart. When you look at it on the daily, it looks even better. Here on the daily, your breakdown is right at this candle right here. So on the Russell, you have the 20-day moving average that's already starting to point up. You have the price action that's already over the 50-day moving average. Now we're at reaching that breakdown candle, which is right around, let me see, that is the high that day was 193.93. So 194 on the Russell. You guys have heard me say over and over and over, the Russell is the leading indicator for a change of direction, and right now the Russell is telling us that it might want to change direction. Unfortunately, we're not there yet. We need to close a candle over this line before we think the market has changed direction. I don't see the Russell reaching over this line before Friday. I'll be surprised if it does, but more than likely Friday morning we'll be right on that line. And when economic data is red, we're either going to make a leg down or we're going to make a massive move up. It's going to be one or the other. You could flip a coin and have pretty good odds of getting it right. We don't know. I don't know which way it's going to go, but I can tell you that the Russell is performing better than the S&P, and the Russell is performing better than the Nasdaq. It's closer to reaching a breakout point than the other two. I talk a lot about sectors. If you look at the sectors, you can tell that the financials are looking like they're wanting to turn around. The financials right here looking like they're wanting to turn around. Energy has been the leading sector, but when you look at energy, one thing I want you to understand is that every sector has a subsector. Energy has been outperforming, but the leading subsector in energy is TAN, which is solar energy. That's a riskier subsector. That's a risk-on subsector of energy. Technology looks like it's coming back up, but there's a subsector of technology that is outperforming, and that's SMH. That's the semiconductors. When SMH starts outperforming the whole of technology, you can tell that risk is coming back onto the market. So you could see a rotation going into risk in the background, but the rotation is very slow and it's very methodical because everybody again is waiting for the economic data to be read. Now, I can't just give you the bull case and tell you that just because technology looks like it's about to break out of its, or I'm sorry, just because I think that the Russell is about to break out and it's reaching that point, that doesn't mean that it's there yet. There's a very strong bear case that you always have to be aware of. And in that bear case, down here we have the cycles that I talk a lot about. As you could see when I put my cursor here, you can see that for the most part the cycles align. The middle of the long cycle aligns with a low. The top of the cycle aligns with a high. And as long as the low in this cycle is lower than the next low, so there's the next low, so that's an uptrending market, because the cycles are telling me that the next low is going to be lower. But once you get over here and you see that the lows start coming lower every time, all these, so you have the minor cycles here and you have the low right there has a lower low, and then the next low is a lower low. Well, right now we made a low, but we made a low at the middle of the cycle. Because we made a low in the middle of the cycle, the bear case would be that price action is going to move to make another low at the end of the next cycle. So the bears have a case. They always have a case. It's a good case. It's a smart case. According to the cycle, we're not at a low yet. According to the cycle, we're going to make a new low. Another chart that I want you to look at for the bear case is, you all heard of the banking collapse in 2008, and we had a low, and right at this low right here, Bear Stearns announced their bankruptcy. They started shutting down, and right when they announced that, the market started to rally. The reason the market rallied that particular spring, that particular summer, was because the hedge funds were tricking other people into buying positions, saying this is the worst of it, and they were tricking people into buying, and then they just dumped all their positions at the end of the year. So we haven't hit this June. You could see right here, June typically goes down. It's normal for June to go down, but this particular year right here, it was a trap. It was an absolute trap. The hedge funds knew they were doing it. There's plenty of articles written about this happening. They trapped people so they could dump off all their positions, and it crashed the market. Now, this year had a catalyst. The only thing I can imagine would be a catalyst right now is if we start reading a second consecutive quarter of negative GDP, interest rates being raised by more than 0.5%. Those things would be a catalyst for a new low. But I will say, in the meantime, until we get to this line, I'm playing to the upside. Once we get to that line, I'm exiting positions, and I'm going to wait to see what happens. It does not make sense to get to that line and be expecting an up or expecting a down. Trade what you see, not what you think. Please remember that. If you have any questions, by all means, ask on the Discord. We have a lot of very qualified people there. We put a lot of time into trying to get you guys ready for the market. So make sure you give us a thumbs up, like the channel, share the channel, and we'll see you on the Discord.